Sure, it works better if I stand up. Thank you very much for inviting me. It's a pleasure to be here. First time at Carolina Central University. And it was a very interesting story that we just heard about how it all started. I'm sorry that Patricia couldn't come here as well to go back to Britain. So I'm talking about something that has to do with this mysterious business of asymmetric or imperfect information and incentives. But I'm not going to do any really technical economics. I hope that you won't be bored by the lack of diagrams and equations and so on. But I honestly think also, I think that there are rather important problems in the world. I think I may have been particularly stimulated to do this when this is, we spend all our time traveling around the world these days. And I was in an airport in Britain this time, on my way to Scotland. And there's a picture on the television in the airport of the governor of the Bank of England. So I cracked up. He's a friend of mine. He's a very good economist. Became governor of the Bank of England. And he was up before a committee of the British House of Parliament because there had been this bank run on the Northern Rock Bank. And he had to give his excuses for this problem. And all the time he was trying to teach the parliamentarians, the members of parliament, about moral hazard. He said, this is the problem. So I'm going to tell you why moral hazard is a problem here. And I think it's a problem in a rather interesting way. I thought I'd better begin by telling you a little bit about recent events, first in Britain and then in America, even although I suspect you probably know a lot about this already. So this is recent stuff. It was only in September this bank in Britain suffered a bank run. Now this was a media event. The newspapers, the television, and lots of pictures of long queues of customers outside bank branches wanting to withdraw their money from the bank. This is the kind of thing that people have heard of, but it seems as though for a very long time banks had been very safe and nobody was worried that they might lose their money if they deposited in a bank. Suddenly we had something else. Depositors were afraid that the bank would indeed go bankrupt and would be unable to provide them with their money. Now there were reasons why that had happened. By the way, as Mervyn King, the governor of the Bank of England, said on that occasion, that he thought that the customers were justified in queuing up and trying to get the money out, because at that point there was no adequate guarantee by the government, for example, that they could, in fact, get their money if the bank was in difficulties. In many countries, there is some level of guarantee that bank customers, that if they have money in deposit accounts, they are going to be able to get it, whatever happens. And we didn't have only a fairly low level in that part. Well, what had happened was that this particular bank was rather specialized. It had been what we call a building society. That's to say, its business had been to give people loans to buy houses, mortgages, in other words, and to take deposits from people, which would be kept fairly long run and would give people interest. So it wasn't a bank in the retail banking sense until relatively recently, a few years ago. It changed, it extended its business. A lot of building societies in Britain had changed their nature so as to become ordinary banks. Nevertheless, it didn't actually have very many branches, and it didn't do an awful lot of ordinary retail banking business, where credit cards and checkbooks and so on. That was one of the reasons why the pictures were so dramatic, that there weren't very many branches, and so people had to go to one of the few branches there were, and it made it look all worse than in the way it really was. But what had happened was that Northern Rock found that the cheapest way to get money, or very importantly, was to borrow in what is known as the interbank loan market. That's to say, to borrow from other banks, and to borrow from other banks in very short term, so that the money would have to be paid back. I actually don't know quite what the term was, but something like a week or so later. And then you borrow again. This may be something that rings quite a loud bell with people in this part of the world, because that is, of course, what South Korean government particularly was doing at the time of the crisis, roughly 10 years ago, when they looked as though they might have to default, because that particular short-run loan market also had a certain very big increase in interest rates. In August, actually, the bank felt that it couldn't any longer borrow on that. People were not willing to make loans or not at an interest rate that seemed to be at all attractive. And why were they so reluctant to do that? They were reluctant because of subprime mortgage problems in the United States. These, of course, are mortgages. Subprime is just jargon. It means that these are the ones that have a higher default risk. But, at least as we look at it now, it doesn't seem to be very high quality loans, fairly high default risk. And a lot of these mortgages were and are defaulting, so that the banks, I believe it's mainly banks, that had lent money to them were not going to get money back. At least they, of course, would get the value of the houses, but house prices had fallen significantly in most of the states, and so they were only going to get a portion back. Now, one of the key things we'll talk about is who exactly is going to get money back or not get money back in this situation. Because, of course, the problem wasn't that the Northern Rock Bank in Britain had lent to house buyers in America of low quality. It was that the Northern Rock Bank in Britain was wanting to borrow from other banks, mainly in Britain, and these other banks had bought securities from somewhere, from the financial market, and these securities were based indirectly on the mortgages that had been done in the United States. So there was actually quite a long and complex chain connecting these queuing depositors at the Northern Bank in Britain to what was taken to be, in some sense, the real cause, namely that people, many ordinary people in the United States, found, or believed they had found, that they could no longer keep up the payments on their house loans and must default. And I, of course, as an economist, I don't think that at that point, we've reached the cause of the problem. I think the cause of the problem is from the bank, even earlier. And that's what I'm going to talking about. It seems that many of these big banks, you see, had purchased assets that weren't straightforwardly taking over the responsibility for handling these mortgages. Big banks had purchased assets that were combinations of, there were securities that were defined as being bundles of these mortgages or were somehow related to bundles of mortgages. And of course these were mortgages in which default became common. Big banks then were unwilling to lend. They were particularly nervous about any institution whose assets were mortgages, even although I don't think that there was any serious risk attached to the mortgages of the Northern Rock Bank. And the greater problems here are not the customers of the Northern Rock. In fact, the British government introduced a complete guarantee of the deposits. The bank run stopped. It's true that there are continuing problems with the Northern Rock Bank, which will probably have to be bought for very little by some other institution in order to survive. But that's not really where you would say there are serious problems. Problems are when individuals actually suffer in some way. These problems come partly through the reduction in the value of many big financial institutions, banks, and that's a loss because it's a loss to people who own shares of these institutions. It's probably also something of a loss to some of the people working in these banks, probably not as much as it should be. And of course, above all, troubles of the defaulting house borrowers. Because if you have to give up your house, having paid a fair amount for it, then that's not a very satisfactory situation. And really, one doesn't think it should happen. Now, the trouble in all of this is the existence of what has for a long time been called moral hazard in these markets. And I want to underline this. It's not absolutely straightforward, because moral hazard comes up in different ways, and I'm going to emphasize two of them. There is an economic theory of this. That's what I'm going to tell you something about. Economic theory of moral hazard can indeed be applied to these markets, not absolutely straightforwardly. I'm now going to take a little bit of time to tell you about the theory of moral hazard and what the economists have to say about it. I'll talk about it mainly, but not entirely, in terms of credit markets, that's to say, markets for loans. But these are particularly interesting and extremely important markets. There's so much goes on in them. The first thing I want to emphasize is that markets as such are not always as good as tends to be claimed. There is an ideology about things that says markets are the way to go. This is how the world, or the economic world, ought to be organized. And that they really don't have any problems if they're working correctly. I don't think that's right. And I think we're talking here about an area where markets are not, do not necessarily work right. And that will actually require policies of various kinds, government intervention, if the problems are to be corrected. Perfect markets. Well, this is a term of art in economics, of course, and I'm going to give it a rather special meaning. Perfect markets with well-informed traders. These are pretty good. They really do achieve something well worthwhile. No complaints about it. In these markets, there are two different things that I want to emphasize about them. One is that the buyers and the sellers are effectively anonymous. You are, if you're buying something in an ordinary perfect market, it might be vegetables in a shop or a supermarket or something, you don't know who exactly is supplying these, certainly going to remain. And the people selling don't know who you are. There are lots of you and there are lots of them. So it's a market where there are a lot of people on each side, and it's a very neat device that a price can be there and advertised, and you simply trade at that price. So you're somehow or other, as a buyer, interacting with an automatic anonymous mechanism which is described by the price for what you buy. And if you're a seller, similarly, it's just the price that you get for selling. And it's not people doing it to. You know it's people, but it doesn't matter who they are. But also, the buyers and sellers know what they're trading. By which I mean that they know the quality of the goods. That's the ideal. That it's all very clear what kind of commodity you're getting. Now, we know that in many situations that's not exactly right. We read stories regularly in the press about the problems of quality of goods. China's been getting a bit of trouble recently because of imperfect toys or other imperfect commodities. They're a pretty small part of the total amount that they're selling. But we know with many commodities there could be problems about that. These are interesting problems. I'm particularly interested in the way that could be a problem in credit markets. And in credit markets, and indeed most insurance markets, it's not so easy to know quite what is the quality of what you're getting. Why do I say that? Well, because if you're getting a loan, a very important aspect of a loan is what's the chance that there may be default. There are many, many loans where the chance that there's default in the loan is very small. It's not going to be paid back, it's going to be paid back almost for sure. A lot of bank loans seem to be that character. And there you could well say that, yep, the borrower knows exactly what the terms of the contract are and is going to follow these, and furthermore the lender knows that they will be followed. So both sides know what the quality is. That would be reasonably perfect. Although there is another aspect here, is that it's not anonymous. It seems to be intrinsic to the whole business that you wouldn't expect the lender to be unaware who is borrowing. And for that reason, the borrower is not going to be unaware who is lending. The two parties to this contract are going to have to know something about one another, at least one way or the other. And if they have to know, it sort of follows that they're not going to know properly. Most insurance, of course, is done by contracts with named individuals. If you have fire insurance for your house, the insurance company wants a lot of information about who you are and where your house is and all of that. So it's a unique contract for you and your house. And there are reasons why it's like that. It's not that you just go into a shop and buy insurance for some anonymous house. It couldn't be, because if anything happens, if there is a fire, if the house burns down, it has to be verified that it was indeed that particular house. It was your house that was burned down. So there isn't the possibility of anything of a totally anonymous market. Or you'd say, yeah, but there are other very similar houses, so there may be very similar contracts, and that's true enough. But that's not the same thing as the kind of trading you can have that is completely anonymous, that is the ideal market that you should call the perfect market. The outcomes of these contracts, whether or not insurance has to be paid because of the fire, That's going to depend on the individual experience. You can't buy an arbitrary amount of insurance, like you will be paid such and such an amount of money if your house burns down. The house may be worth a few $1 million, Hong Kong, like that. You can't go along and say, I'd like to buy insurance for $500 million. You say, well, why not? If it were a perfect market, then we could do that. Let's say, well, there's a price for such and such a quantity of insurance to buy. Of course, there are very good reasons why not. That would be a pure gamble of a particular kind. And the reasons why not are the moral hazard element. Namely, that the chances of there being a fire depend on your behavior as the insured party. And the insurance company might well be suspicious that you took out an insurance that was in value many times the value of the house, that you would clearly have financial interest in there being a fire. And then it might happen. That would be moral hazard. Insurance companies have been concerned about this for a very long time. I have no idea when they first started discussing the issue of moral hazard, but I guess at least 100 years ago, probably more than that. We're talking about an idea and a fear that is not particularly new in economics. It's a well-established phenomenon. So the way we put it quite abstractly is that the profits of the insurance company are going to be affected by the actions taken by the person who takes out the insurance, and that these are actions that may not be observable by the insurance company. They may not be able to take you to court to determine whether or not you have taken sufficient care. Now, it may be that if it's actually found that you started the fire yourself, well, that's one thing. But suppose it's just that there are many of your actions that affect the probability of being a fire. For example, how much time you spend in the house, whether you smoke, or whether you allow friends to smoke, or whether you have the electricity checked regularly. These are all things that can affect it. Some of these will go into contracts with the insurance company, but observation will not be accurate. All of this is an issue because the nature of the contract between the insurance company and the person taking out the insurance is expected to influence behavior. Perhaps it's clearest in something like accidents or medical costs. If you have to pay, suppose you have to pay a specified proportion of the accident costs yourself. Now let's talk about car accident. If the terms of the insurance say that you will only get a proportion of the costs back from the insurance company, that would obviously give you an incentive to reduce the probability of having an accident. Also, perhaps to reduce the intensity of the accident. But what I'm after is that it gives you an incentive to reduce probability. What does that do? If you're less likely to have an accident, the insurance company is less likely to have to pay out on the insurance. Therefore, the insurance company will have lower costs, and therefore its profits will be better. Now, you can see, therefore, that the insurance company has an incentive to think about the possibility of devising a contract that will give you an incentive to take care. And that's, of course, what insurance companies do. There are two things they can do, you see. One is they can put in the contract requirements that you take care of particular times, like, say, having the electricity checked regularly in the house. reduce the probability. The other thing they can do is to make sure that you have financial incentives to take care, even although they will not be able to observe whether you've done it. But if there are competing insurance companies who all give you these incentives, then the benefit of writing contracts that way should in principle come to the people who get the insurance, not to the owners of the companies, the insurance companies, because they will compete with one another. If a company has chosen contracts of such a form that people will be quite careful and the probability of fire will be less, it can charge lower premiums. That's the price of the insurance will be lower from that company. It will attract customers by doing that. Competition amongst the insurance companies will bring down the cost of insurance, and everybody benefits. So having contracts that are devised to give incentives of an appropriate level will be to the advantage of people who are insured. That actually really needs emphasized, because you will see some various points coming along shortly which you may wonder whether that's really to the advantage of people being insured. But you would expect it to be in the insurance world, and it is. Now, for this area, economists have come up with three broad principles that should govern the way these markets would work. Not perfect markets, but markets. One is that because of these incentive issues, there should be what's called co-insurance. This first principle, by the way, is by no means entirely correct, but it was put forward. The idea was that usually the insured party should pay part of the accident costs, and for the reasons that I've been sketching, that it will give the insured party an incentive to do it. The reason why it may be misleading to call it co-insurance is that this is not always the best way of providing incentives. We'll talk about that in a moment. The second principle, that there should not be anonymous markets. That's to say that there should be a single insurance company that gives you the insurance. If we're talking about things like fire insurance of the house, accident insurance for a driver, fire, it will be a condition of the insurance policy that no other company will give you insurance for the same risk. That you are required to take out no other insurance on the same risk. I'll explain shortly why that should be true. Maybe it's obvious. And there's a third principle, which insurance companies don't seem to have been so aware of. They were aware of the first two issues, and these are normally to be found as part of contracts. And that is that it's often desirable, when there's moral hazard, to have taxes or possibly subsidies on a variety of commodities that somehow affect unobservable behavior. Straight away, I'll give you an example, although you may be already doing it. But suppose that for some reason it's not really possible to tell whether people have fire extinguishers in their house. Well then, if the government were to have a subsidy on fire extinguishers, so you didn't have to pay as much as the actual cost of making these things, that would reduce the probability of fires. And it would reduce the costs to insurance companies. It would make the insurance contracts more profitable. It would bring down the premiums. All of the argument I was using before would say this would actually be to the advantage of people getting insurance. So that's a third principle. When you're dealing with moral hazard, you should be looking out for possibilities of that kind. And sometimes they might be very important. talk a little bit about each of these principles before we go back to credit markets, and I explain what all this has to do with credit markets and problems. Well, co-insurance, the contract should give some incentive to reduce costs, that's what we say, and one way of doing that would be to have the insured person pay a share of the costs. You'll be aware in insurance that it doesn't always happen. That's not our subject today, I won't go into it. But I will point out that it's not necessarily optimal to do it that way. Another way of doing it might be to have something in the nature of a punishment for exceptionally bad outcome. An obvious example is a chief executive or a minister losing his job if there's an unusually bad outcome. That's to say, he's been unlucky. And I think it's important to realize here that the bad outcome will usually be because of bad luck rather than because of bad behavior. But you have this punishment in order to give incentives to have behaved well beforehand in advance. And actually it turns out when you do the economic analysis that it can, in many circumstances, be a good idea to concentrate the incentives on the bad outcomes in that way, which is a very different way of doing it from having a share in the costs. The second principle, which I like to use the English language proverb for, too many cooks spoil the broth. It's one of those things one's brought up with at home, with the suggestion that if you had several cooks in the kitchen all cooking the same dish, you might all come past the pot and add seasoning to it, and you'll end up with having too much seasoning in the dish. So it will spoil. Of course, the idea is much more general, that if there's a particular task to do, that the task is likely to be done best by one person doing it rather than several people all getting in one another's way and doing it. And that seems to apply very much in the area of moral hazard. You should not be able to insure the same or related risks with many companies. Because, why? Well, each one of the companies would free ride, using a nice economic concept, it would free ride on the incentives provided by other companies' contracts. So if another company has already given insurance of the kind we talked about, which gives incentives for people to take care, well then it's no longer so important for you if you're allowed to offer an additional insurance contract. You don't need to worry about that. But the net effect of all of this, and a lot of different people offering insurance for the same risk, will be that the incentives get eliminated. Because people will then go on, it will be like a captive market. So you buy your insurance, you pay a certain price for the insurance. You can't have complicated contracts which require that you know the person you're dealing with. So if it were an anonymous market, this is what you would get. But it would mean that you'd have contracts that did not provide any particular incentives to take care and to reduce the risks. Contracts would give full insurance, so you wouldn't have to pay anything for an accident happening to you, you're fully compensated, but you'd have to pay a very high price for that insurance, just because the risks would be the maximum. And the third element I talked about, desirability of external taxes. Well, I think driving insurance is perhaps the best example of this. A major influence on the probability of having a car accident, obviously, is the number of miles or kilometers that you drive. If you were to drive less, your probability of an accident would be reduced proportionally. That's straightforward. It's equally very difficult for an insurance company to apparently, it's costly. Insurance companies don't do it. to tell how many miles you have driven. If the government puts a tax on petrol, that will encourage people to drive less, and that will reduce the probability of an accident. Of course, economists have calculated what sorts of taxes you should have on driving. There are essentially 4 different things you should worry about. There's the congestion effect. I say if you can get people to drive less, there will be less congestion on the road, people don't get in on the motorway. There's the pollution, the local pollution effect, through nasty things coming out of the exhaust, which may be bad for health and pleasure. There's the global pollution effect, the global warming results. And there is also this accident effect, the impact on the probability of accidents through the amount of driving that people do. Well, the biggest, in the calculations people have done, the biggest element of the tax you want is the congestion effect. But the second biggest seems to be the accident effect. It's really quite big. Whereas these other, the normal externality effects, the pollution and global warming effect, are not immensely large. Like the global warming effect might be the magnitude like 10 US cents per liter, a little bit more, and you get a much bigger effect in accident probabilities of anything. At least that has been claimed. So we may be talking about something quite important. This makes everybody better off. Here's a tax that is a good thing, because provided, of course, that the revenue is used for something else, like reducing other tax rates, it makes everybody better off. Time to come to the credit markets. What's it got to do with credit markets? Well, it applies at several levels, and I'm going to emphasize 2. The borrowers, the people who took out these subprime mortgages in America, who borrowed in order to buy a house, of course they had various kinds of unobservable behavior, which affected default. It all has to do with your circumstances, of course, how well you work, whether you manage to keep your job, whether you are careful about what you spend on other things, so that you can keep managing to pay the mortgage. A lot of things are apparently unobservable. It turned out that quite an important element in this was the question whether you would tell the bank the truth about your current wage and recent employment history. Because a lot of people, it turns out, gave fraudulent, incorrect replies when asked questions about that in determining the loan contract. Now, if you think about it, you might well conclude that maybe these things are enormously important. In the case of these mortgages, are important, maybe not enormously so. But at any rate, it would imply that optimal contracts would have rules that govern repayment and its timing, and that these would depend presumably on the financial circumstances of the borrower. That's to say, you would expect the contract to be written in such a way that if the borrower moved into difficult times, in a sense, like losing a job, for example, that the borrower would not be required in that period to pay so much back, like say lower interest or something of that kind. This is the sort of thing that you would expect to be done in designing a contract that would be appropriate to the borrower. Of course, such things were not done. And by the way, one thing you certainly would not expect is a random interest rate. One of the major things that happened in the subprime mortgage world was that interest rates increased. The lending companies then increased the interest rates that people had to pay on their mortgages quite substantially. This was part of the initial contract, that the interest rate might well change. Indeed, some of these contracts had very low interest rates initially, which would be increased gradually over time, and increased not according to rules, but you might say at the whim of the lender. The lender thought it might be nice to charge a higher interest rate, the lender would do so. Of course, the higher interest rates you don't necessarily pay. At any rate, you wouldn't expect that. But now I want to say there's another, and I think probably more important element of moral hazard. Now think of the lender, let's say the banker, who is deciding whether or not to give a loan to somebody who's come along and said, I would like to buy a house, please lend me some money. Well, the lender has to do something. It costs something to do this. This is what bankers are for, or people in saving and loan associations or whatever. They have to talk to people, they have to find out things about them, they have to decide how much they're prepared to lend, and they, or at least their superiors, have to work out what form of contract to use for the loan. So if the lender is doing all these things, you may take it that in a sense many of them are also unobservable to those people who might consider perhaps lending to the lender. And that seems to have been the key element in the recent crisis. The relationship between the banks lending mortgages and others who lent to these banks. If the lender were to insure in any way against the risk of loan default, the principles that I've been talking about, principles of moral hazard, should apply to the terms of that insurance. Now, in fact, that insurance was provided by an old-fashioned market, and that was, we should expect that to be bad, and it was. But what happened was that securities were invented. I think the term securitization is used for this, that would bundle together a lot of mortgages, and then these would be called assets of a particular kind. A lot of names are invented, and these are then sold on markets. What does that mean? It means that the original lender for the mortgages has sold on the risk, but he's done it not by taking out an insurance policy on the specific risk of this loan, or even a bundle of these, but by having them put together in a security which is simply sold anonymously in a financial market. And of course, we now find a situation where big banks are claiming that it's very difficult for them to tell quite what risks they have. It's all very obscure because these securities bundle a very large number of loans, many of which are non-performing. Use the local Chinese terminology. The lender in the mortgage market, under these circumstances, has no real incentive to lend carefully. This is what the theory is saying. That if you have that kind of securitization of the loans, then if you were just to imagine, this is not the truth, but if you imagine that the lender is a rational economic player, then the lender will have to think in wondering whether to be very careful about choosing who he lends to or working out suitable terms of the contract. You have to think, well, so what's the impact on our profits from this? Apparently, no real impact on banks' profits. Probably whatever incentives go to the individual banker making the loan were of the form that say, well, of course, if you make a loan, you will get a bit of commission on having done that. So the more loans you make, the better. Whether they're very risky loans or whatever, it would have no effect. So that there's no incentive for the lender to devise suitable contracts. And as a consequence, you would expect there to be considerable default. Now, it so happened, of course, you would just normally expect a fair amount of default, but general circumstances changed. As to say, house prices fell significantly in America, interest rates rose significantly. All of these things changed in such a way as to create a lot of default. But the possibility of default was already in the system by people deciding to do this lending. The lender has no incentive to devise contracts that will, for example, allow rescheduling of mortgage payments, or to arrange the contracts in such a way that when events get bad, that somehow people don't have to default, but may simply postpone their payments. It seems to me, without knowing the details, that the fact that there has been so much actual default is ridiculous, because instead people should be having rescheduling of their loans, or even changing the terms of the loans. You could say that you could imagine similar arguments being applied to inter-country loans, particularly loans to developing countries. We won't go into that today. So there was no incentive to supply or encourage, for example, fixed interest rate borrowing, which would have greatly reduced default risk, of course. Generally, there was inadequate incentive to create mortgages with good incentive. So we're saying it's a two-level problem, that moral hazard applies both to the lender and the borrower, and it's the fact that the system did not induce people to devise appropriate contracts that seem to be very significant. Now, it's true that what we've observed, a major part of the problem, is that the risks on the different mortgages were not independent. The rise in interest rates, fall in house prices affected them all. So therefore you get an awful lot of this happening. Of course, buyers should have appreciated this. It's possible that they did. I have no insight into this, whether the big banks were buying assets that they knew to be very risky, but had a high expected return. What's the nature of these assets? Now, a high expected return with a big risk means that there's a possibility that you may make substantial losses, and that the value of the firm may be greatly reduced, and you will then have to sound very sorry to your shareholders, and you will be embarrassed. But you may be thinking to yourself, well, of course, I knew that was one of the things that might happen, and it might have gone quite the other way, and we might have done tremendously well. So one shouldn't always assume that when people sound very regretful and say there's a great crisis, that they didn't, in fact, plan, knowing that it might not happen. That's how it should be, in fact. They should have known that this might happen. They may also be thinking that past experience suggests that governments sometimes come in and pay off in such circumstances, so that the incentives are even worse than you think. The stock market, of course, creates a similar problem, by the way. Just by the way, to remind you, of a common theme in economic analysis. Who creates incentives for managers and entrepreneurs? Well, it's the owners of the firm, let's say. But if this is a joint stock company where the owners are very dispersed, then no individual shareholder can have very much influence. In effect, this is bringing too many cooks into the kitchen again. You think of all these individual shareholders, it's a bit of an analogy rather than precise equivalence. But it's as though these were all different people. It's as though the people actually running the firm had contracts with a lot of different individuals, and that doesn't get the incentives right. For myself, I'm quite inclined to draw the conclusion that having joint stock companies is not a very good way of organizing the economy. You just don't get the right incentives for managers of firms if you world that way. The central bank, of course, is lender of last resort. That creation affects banks' incentives in particular ways, and the central bank should, of course, be thinking about the nature of its contracts with banks and the impact that might have on their incentives. And that is where Mervyn King, Governor of the Bank of England, was very aware of the situation, and it's how, in a sense, he got caught badly by the situation, because he wanted all of this to be very expensive for the banks. He thought that the banks really should suffer for having made the choices they had for getting these dubious assets with bundled subprime mortgages and so on. And he didn't therefore want to get very far into the business of rescuing banks. Not even the Northern Rock Bank, which was, as you remember, very indirectly connected to this, but it had, in a sense, been doing the same kind of things, carelessly borrowing anonymously in the interbank short-run credit market, and therefore not taking any account of incentives down the line elsewhere. But in the end, of course, it's not possible for governments or central banks to stand back completely from this, and perhaps once the system has been allowed to develop this way, it should take action. I think they did the right thing in saying that they would guarantee depositors, at least smaller depositors, and say, why? Because I don't think that these smaller depositors could possibly have properly appreciated the risks that were involved. They couldn't have got any kind of control on the banks who were lending to them, on their behavior in the wild financial markets where they were lending. So you would want people to have some kind of insurance there. So I think the outcome is fine. One really has to go back and say some way needs to be devised to prevent assets of the kind that we saw occurring. The bundling of mortgages in this way so that nobody pays attention to the incentive and moral hazard problem. But that should be stopped. Could external taxes and subsidies somehow reduce moral hazard in credit markets? What about the third principle that I talked about? Well, as far as I can see, that doesn't work directly. But I think there is something very similar, which is very specific to the nature of credit markets. That, of course, is a very important area. Consumer advice. This is something that has been taken increasingly seriously all over the world. by governments, but it doesn't seem to me that they've gone nearly far enough yet in this. The question is, to what extent should the form of contracts be regulated? Perhaps we might just focus on the particular question of mortgages. What happens when people take out a mortgage? It's easy to think of it as simply being a loan which you use in order to help you buy a house, and that you will, of course, just pay back. But the question is, on what basis do you pay back? How much do you pay back when? What is the amount you pay back related to various things, like, for example, the general interest rate in financial markets, or maybe your income, it might be. But there are a lot of possibilities there. It could also be related to your age, for example, or the kinds of jobs you have. Most people, I take it, would find it a little bit difficult to choose amongst the alternatives. So what actually happens is that the lender, usually the bank or the person working for the bank, says, well, I think this is the right kind of thing for you. And it doesn't appear to me that when people do that, that they really mean this is the right kind of thing for you, they mean it's the right kind of thing for me, the bank. Because, by and large, the terms of mortgages don't look as though they're the kind of thing that suit people. I've already remarked that in theory, you would expect these contracts to be related to the individual current circumstances of people at the time of repayments. So that, for example, it might well, how much you pay might well be related to your current income. That would be one reasonable possibility. Also, the question, of course, of how much of the value of the house should you be prepared to lend. That comes back to things like what determines the general level of prices of housing in the economy. If banks lend very large amounts for each particular house, this of course drives up the prices of houses generally, and to the extent that it may almost defeat the intention, which is to allow people to buy what otherwise they couldn't. It seemed to me, when you have imperfectly rational choice by people, and so I'm sure that applies to most people who are to buy houses, I actually think it also applies to most people in the financial sector who, despite their excellent training in university departments of finance and so on, perhaps are not all that good at thinking out the consequences of contracts. What they're good at is thinking out the variety of outcomes that we have. But no question, thinking about probabilities is for most people pretty hard. And you can see that if I don't know how it's done in Taiwan, but in Hong Kong, if you want to buy even quite simple assets like funds based on stock markets, that the bank is required to ask you to say which of a variety of different kinds of patterns of returns you would prefer. In other words, you want to know what your risk preferences are. And I find this pretty difficult to be shown these pictures, so of course I mentally translate them into numbers and probability distributions, and then I can choose. I don't think most people can do that. I don't think that people have the time really to think this out, or the training, or maybe even that doesn't mean that it doesn't matter what happens. What I think it means is that you have to have a group of people, specially qualified, specially trained, thinking really hard for quite a long time in order to work out what may be appropriate forms of contracts. I'm not saying necessarily that there will only be one, although I think you might get close to that in many cases. And for that, I would have thought a government agency is what's required to think out the right form in these contracts. And I think you could make a case at least that government should actually constrain the allowable forms of credit contracts. And this, I thought, would mean no variable interest rate mortgages. Actually, that's maybe going a little too far in a complex issue. I won't attempt to get at now. And probably it's a case where we have some of this already. The government should regulate the kinds of securities that can be created. Though I don't entirely see quite how this can be satisfactorily implemented. Ideally, it would be impossible to take out effective insurance from more than one supply. The problem is to determine what is effective insurance. Because, of course, at first you might not think the credit markets were really providing insurance. Just that I'm claiming that they are, really. Almost every asset in financial markets is providing a certain amount of insurance or is providing a kind of a gamble. So you begin to think, this might need a tremendous amount of regulation, very hard to see how it can be done. And of course, we're not really talking about international relationships, but it seems in the case of these would be even harder to control. And although one might say it's desirable, it's very hard to see how it could actually be done. However, I think what I've already indicated might not avoid the next crisis. I think this thing, as usual with economists, we can always avoid the last one.